This tutorial is a project of nonprofitaccountingbasics.org, a free resource developed by the Greater Washington Society of CPAs Educational Foundation.
Hi, I'm Ben Takis, founding attorney at Tax Exempt Solutions, and in this webinar we're going to talk about the basics of the Intermediate Sanctions rules. The Intermediate Sanctions rules set forth in section 4958 of the Internal Revenue Code and the Treasury regulations issued under that code generally govern transactions between nonprofits and the people who run them. In other words, conflict of interest transactions. These rules seek to ensure that amounts paid to the people who run nonprofits are reasonable. Basically, what we want to do is ensure that the people who run nonprofits are not using the organization's money and assets for their own personal benefit. These rules deal with some very fundamental issues that go to the core of what it means to be a nonprofit organization. If you have a nonprofit out raising money for a charitable cause, then it wouldn't be right for the organization to distribute all the money to its directors and officers. And these rules deal with those issues. Prior to the passage of the Intermediate Sanctions rules in 1996, the only federal rules governing conflict of interest transactions were the restrictions on private enormement. Private enormement refers to the prohibited practice of using a nonprofit's assets to unduly benefit the insiders who run the organization. The enormment rule was not by itself the best tool to prevent this practice for a couple of reasons. First of all, the penalty for engaging in private enormment is revocation of the organization's tax-exempt status. It turns out in practice, the IRS was reluctant to impose this penalty in all but the very extreme cases. So the rules were not doing a lot to discourage the less extreme but more prevalent cases of enormment. Second, the penalty for engaging in enormment is a penalty on the organization itself, but not on the people who are improperly getting the money. So for these reasons, the Intermediate Sanctions rules were passed. The Intermediate Sanctions rules provide for an intermediate penalty for overpaying insiders. That is, a penalty short of revocation of tax-exempt status. The penalties take the form of excise taxes imposed on the organization's insiders and managers. So to apply the Intermediate Sanctions rules, we need to understand three core concepts. First of all, applicable tax-exempt organizations. These are the organizations that are subject to the rules. Second, there's the concept of disqualified persons. These are the insiders whose transactions with the organization we need to watch more closely. And lastly, there are excess benefit transactions. These are the transactions in which disqualified persons have been overpaid and that are subject to the penalties. Before we talk about these concepts in more depth, let's first go over what the penalties are. First, a disqualified person who benefits from the transaction is subject to a penalty of 25% of the amount of the excess benefit. However, this penalty will jump up to 200% if the transaction is not corrected within a specific period of time. So these intermediate sanctions are generally found during an IRS audit. The IRS determines that they want to apply the penalty. They will mail a notice of deficiency which assesses the tax, makes it clear that the tax is payable, and then you have 90 days from the date of that mailing to pay back the amount that was improper. So excess benefit transactions need to be repaid to the organization. Second, organization managers who knowingly participate in the transaction are subject to a penalty of 10% of the amount of the excess benefit. Generally, knowingly participating means that the manager of the organization was aware of the facts and aware that the transaction could violate the rules, but the manager did not make a reasonable attempt to determine whether, in fact, there was an excess benefit transaction. Lastly, keep in mind that revocation of the organization's tax-exempt status under the private enormment rule is also possible. So the enormment rule is still there and still a possibility. First, we'll talk about the concept of an applicable tax-exempt organization. The intermediate sanctions rules apply to three types of organizations. First, 501c3 public charities. However, this does not apply to private foundations, which have their own more stringent rules called the self-dealing rules. Second, there are 501c4 organizations. These are called social welfare organizations. They're similar to 501c3s, but they don't get all the tax benefits of a 501c3, and generally they're allowed to do more lobbying. They're also subject to the rules. Lastly, there are 501c29. This is a newer type of entity called a qualified nonprofit health insurance issuer. And if this was you, you would know it, so we won't spend a lot of time talking about that. Now, what if you've had your tax-exempt status revoked for some other reason? Does that then mean that you could distribute all the organization's money to the directors and officers? No, there's what's called a look-back rule. So the rules apply to organizations that had the status at any time during the 5-year period ending on the date of the excess benefit transaction. Next, there is the concept of disqualified persons. This is the most complicated part of applying the intermediate sanctions rules, but it is absolutely essential for an organization to know who its disqualified persons are. Organizations should have a current list of disqualified persons at all times. It's necessary not only for applying the intermediate sanctions rules, but also for implementing the organization's conflict of interest policy and completing the Form 990. The general rule is a facts and circumstances test. So the term disqualified person includes any person who was in a position to exercise substantial influence over the affairs of the organization at any time during the 5-year period ending on the date of the excess benefit transaction. Again, this is another type of look-through rule, meaning if you have a director on the board who quit the board 4 years ago, they are still a disqualified person, and you need to take care in any transactions that you have with that person. There are a bunch of more special rules. There are certain individuals who are disqualified persons by definition under the regulations. This includes, first of all, voting members of the governing body, so directors or trustees. Second, the president, chief executive officer, or chief operating officer. In other words, the person who is first in charge of running the organization's day-to-day operations. Lastly, the treasurer or chief financial officer, so the person with ultimate authority for managing the organization's finances. Second, there are certain individuals who tend to be disqualified persons based on the circumstances. This includes the founder of the organization. Also could include substantial contributors. Also, persons whose compensation is based primarily on the organization's revenue. So fundraising consultants who earn a big commission based on how much money they take in, they could be disqualified persons. And other high-level staff, such as people who determine a substantial portion of the organization's budget or employee compensation, or who manage a discrete segment or activity that is a substantial part of the organization's activities or budget. Next, certain individuals or entities are disqualified persons by attribution. This is probably the most complicated part of the disqualified person test. First of all, it includes family members of disqualified persons. So spouse, brothers and sisters, spouses of brothers and sisters, and on, as I've set forth in the list. And it also includes corporations, partnerships, or trusts in which disqualified persons or their family members together hold more than a 35% ownership interest. So for example, I once had a client that wanted to hire an accounting firm to do their audits, and it happens that this firm was owned by the wife of one of its directors on the board. So in this case, the accounting firm itself would be a disqualified person. And lastly, there are certain individuals or entities who are by definition not disqualified persons. They are carved out of the rules. 501c3 organizations are by definition not disqualified persons, even if you share some directors in common. 501c4 organizations, at least when the applicable tax-exempt organization is also a 501c4. And employees whose salaries are less than a specified limit. The limit for 2015 is $120,000, but this is subject to annual increases. But this requires that two conditions are satisfied. First of all, the employee cannot be the president, CEO, COO, treasurer, or CFO of the organization. And two, the employee cannot be a substantial contributor to the organization. I should note that there are more complicated rules when you have more complex structures involving supporting organizations, subsidiaries, donor-advised funds. These rules are beyond the scope of this webinar, and the test can get complicated, but this provides a basic overview of the intermediate sanctions rules and the disqualified person definition. Once you've figured out whether the organization is subject to the rules, and you've also figured out who is a disqualified person whose dealings need to be watched more closely, then you need to figure out what is an excess benefit transaction with the disqualified persons. An excess benefit transaction basically is a transaction in which the value received by a disqualified person exceeds the benefit that the organization got in return. This can include, for example, transactions like compensation for services, rental or purchase of property, loans, etc. I'll also add that money or property that is obtained by theft or fraud is by definition an excess benefit transaction if the theft or fraud is carried out by a disqualified person. The rules set forth some standards for evaluating transactions to make sure there's not an overpayment and that the transactions do not qualify as excess benefit transactions. First of all, transfers of property have to be for fair market value. This is the price that would be paid by a willing buyer to a willing seller out on the open market when the two are not related and not under an obligation to enter into the agreement. Compensation for services have to be reasonable based on the services provided. Before we wrap up, I'll talk about two sets of special rules that are very important to knowing whether you have an excess benefit transaction. First of all, there's an exception called the initial contract exception. This exception provides that a transaction is not an excess benefit transaction if it's made with a person who is not a disqualified person immediately prior to entering into the contract, subject to some conditions. So in other words, if an organization hires a new executive director, this could possibly fall within this exception. And the rationale is before you have this first contract with the person is not in a position to unduly influence the organization. There are three conditions to this exception. First of all, there has to be a binding written agreement. Second of all, the compensation has to be a fixed payment, which means either a specific flat amount or an amount determined by a fixed formula that does not involve discretion. In other words, paying a bonus at the discretion of the board would not fall within this exception. And lastly, the person has to substantially perform his or her obligations under the contract during the year at issue. So if you hire a new executive director, but they quit after 2 months and you keep paying them for the whole year, that's not going to fall within the exception. Lastly, I'll talk about some very important procedures under the Treasury regulations, which, if followed, establish a rebuttable presumption that compensation or a transfer of property is not an excess benefit transaction. In other words, this means that if the organization follows these procedures, the IRS will presume that the transaction is proper and does not trigger a penalty, and the penalty will only apply if the IRS steps forward with evidence to the contrary. As a practical matter, this very rarely happens. So to follow this procedure, first of all, the payment must be approved in advance by the disinterested members of the board or an authorized committee. In other words, this generally means directors who don't have an interest in the transaction by business or family relationships. Second, the board must rely on appropriate data as to comparability prior to approving the payment. So with a transfer of property, this could be an assessment of the property value or comparison to recent sales of other similar buildings in the area. This establishes that the transfer is for fair market value. For compensation, you're going to want to look at what similar organizations of a similar size, similar mission, in a similar geographic area are paying for comparable services. For compensation paid by organizations with less than $1 million in annual revenue, data from 3 organizations will be enough to satisfy this requirement. If the organization is bigger, it may need to do a more in-depth survey. Lastly, the board must adequately document the basis for its decision concurrently with making that decision. So this means by keeping proper board meeting minutes that show the data the board considered and the reasoning behind its decision to approve the compensation. So that was an overview of the basics of the intermediate sanctions rules. Thanks and good luck.